Well, I think you might be right that had God designed it, it might have been Bitcoin. But I think, it doesn't look like he did. Much like God did not design a world of eternal peace, no competition between nation states, no lust for power, no greed, and we're all sitting around the campfire holding hands singing Kumbaya. That's not the world we live in. We live in a very real world of competition, and I think this is where gold plays a very important role in balancing that competition. I think, again, in assessing the market forces, there are two areas that Michael continues to use to make his case. First is how he calculates his compounded annual growth rates, and the second is what I think is his lack of understanding of correlations between asset classes and how that reflects upon Bitcoin as a store of value. Okay. First, let's deal with the compounded annual growth. What I've heard from him over and over again is, in all the interviews, he claims that Bitcoin has 196% annual compounded growth, and then he frames it that is going to be achievable each and every year going forward until Bitcoin reaches 1 million, or I've even heard 5 million from him, using statements like it's going to double every 6 months. That's a gross oversimplification and dangerous if you rely on it to make your investment decisions. Calculating compounded annual growth is very sensitive to your entry, starting points, and ending points in the period that you're measuring. It's garbage in, garbage out. And to arrive at his 196% number, he starts at $1 per Bitcoin, $1 in 2011, takes it all the way to $60,000, and which includes the fact that most of that return was front-end loaded into the early years from $1 and up. And I have several problems with that approach. When Bitcoin was $1, it was not a real investment. It was a novelty, it was illiquid, it was tightly held. I'm not sure where you would start the measurement, but it's certainly not $1. And I think it's in the several thousands of dollars. Maybe you can look at when Bitcoin crashed in 2017, settled around $7,000, and that's when the real market started. And certainly I think that real investors have only come in the last couple of years. But I think that if you really allow me to just give you a couple of examples, because what he does, again, is, and I've seen it a lot when I'm being pitched by wealth managers. If I were trying to pitch you on buying gold, I wowould say to you, well, listen, if you bought gold in 1971 at $35 an ounce, and you held it 50 years, it would have gone up 50-fold. That's 6,000%, which works out to about 8% a year of compounded annual growth, which is slightly better than the S&P in that same period. It's pretty good, right? If I wanted to underscore the extreme, I would say to you, hey, listen, if you bought gold in 1971 and you held it for 9 years, which is roughly the amount of time that we're measuring in Bitcoin, you would have had a 42% compounded annual growth. And I think that that's where, you have to always be aware of garbage in, garbage out. Now, again, as I said earlier, he keeps pointing to last year, gold didn't perform, and that's a certainty that it's not going to survive as a store of value. And like I said, you can pick any one of the last number of years for Bitcoin, and I can paint you a much worse picture. So that's the one part of it. The other part of it is how he characterizes store of value or safe haven asset with respect to what it correlates with, Bitcoin that is, and what it doesn't correlate with. And I think that it's really important to understand that to know, again, where Bitcoin fits in a portfolio. Gold has had a pretty consistent negative correlation with equities and the US dollar. That's a given, and that's what's given its safe haven value. And it's an important portfolio diversifier in the event of sharp equity downturns. By way of example, and this is where I will demonstrate how the correlation works. In March of 2020, when the markets crashed, COVID hit, markets crashed, gold went down 8% initially in that month, and then recovered to break even. It did much, much better in emerging markets because there was a flight to liquidity, which usually has a temporary lifting of the US dollar. If I look at Bitcoin in that same month, it went down 40% peak to trough, ending the month down 25%. Bitcoin only really took off in October of 2020 when it looked like the economy was about to recover, so it was risk on. Gold, on the other hand, did really well in the spring and summer of 2020 when the markets had crashed, QE had begun, and it was risk off. And that's, I think, is the very big difference that you have to pay attention to. If you, like myself, believe that equities are in a bubble, then I think there's a lot of built-in downside with Bitcoin at the moment because it really does behave like a growth stock. I think we have to wait and see if there's a major market correction, and when gold establishes its inverse correlation with Bitcoin, that to me will be the evidence that it is a store of value. And we have never seen Bitcoin tested in a financial crisis. So that, again, US dollar crisis, financial crisis, any crisis, that's where you'll see the true test to Bitcoin as a store of value. The other test is inflation. Gold performs really well in periods of high inflation. And I know Michael is suggesting that we're not going to see high inflation in the CPI, and I think he is dead wrong. You only have to watch the commodity prices going up in price, food prices going up in price. Inflation will hit the CPI. There's no doubt about that. But if you look at the 1970s, for instance, which is the last time we experienced high inflation, gold went up 25-fold over a period of 9 years.
Thank you, Frank.